Hello, in this video, we'll be going through the projected benefit obligation gains and losses. Let's discuss the different types of pension plans. The first one is the defined contribution pension plan, where think of it as like a 401k, where the employer contributes a certain percentage of an employee's salary, and then the employee gets to direct how those funds are invested. And then upon retirement, the employee receives whatever is in that fund in their 401k plan, if you will. So there's no guarantee as to how much they will get upon retirement. A defined benefit pension plan is when the employer guarantees a fixed retirement benefit amount. And so when the employee retires, they get a certain amount every month, every year, whatever that pension plan calls for. And those fixed retirement amounts are based on a pension formula on various things such as years of service, annual compensation, and sometimes even their age. So when we're talking about pension plans, we really have two big balance sheet items that we think of. The PBO, which is the projected benefit obligation. This is the liability part of the pension, where this is the money that we project, the company projects that they will owe to their employees upon retirement. There are various items that impact the PBO, and the first one is the service cost. Right, that's just the cost it takes, the increased cost every year as more employees are eligible for retirement. Then your liability has to increase every year. And this plus means an increase to the liability. So service cost is debit pension expense, credit projected benefit obligation. You have an interest cost because this is a long-term liability, so you have to accrue interest on it. There's prior service cost, which only occurs if the pension plan is amended or if it's the first time that the pension plan is put into place during that period. So this one doesn't always occur necessarily, but when it does, it increases your PBO because now you have to accrue for this prior service cost. There's a whole video just for this item if you're not familiar. Another item that affects the projected benefit obligation is a loss or gain on the PBO, which is what this video is about. And it's just when estimates are made, the estimates that are made in the initial PBO are changed or revised. And then finally, retiree benefits paid when the benefits are actually paid out to the employees that retired. Then there's a debit to the PBO because now your liability has been reduced because you're actually paying it out. And the credit actually goes to plan assets, not to cash. We've used this same example in prior videos, but if you're not familiar, let's read through it. Taliaferro was hired by Global Communications at the beginning of 2016. The company has a defined benefit pension plan that specifies annual retirement benefits equal to 1.7% times the service years multiplied by the final year's salary. Farrow is expected to retire in 2055 after 40 years of service. Her retirement period is expected to be 20 years. And at the end of 2027, 12 years after being hired, Farrow's salary is $120,000, interest rate is 6%, and the company's actuary projects Farrow's salary to be $400,000 at retirement. An actuary, just a quick review, is a person that is hired specifically. What they do is they look at statistics and probabilities, and they determine, how many years do they think it will be before employees retire, or how many years will those employees be retired for, right? How long will they live? And also, what do we expect their final salary to be upon retirement? Those are all estimates done by the actuary. But back to our problem, let's see how we calculate a projected benefit obligation for 2027 using a final salary of $400,000, which is one of the several estimates that are used when you have to calculate a projected benefit obligation. We always use our timeline where the employee started working in 2016, and now we're looking for the PBO at the end of 2017, which covers 12 years. We're told that there's the employee is going to work 40 years before retirement, which means that they have another 28 years to work. And then 2055, they're retiring for an estimated of 20 years. So the way we calculate the PBO, if you're not familiar with how the PBO is calculated, there's a separate video for that. So I'm going to go really, really quickly. Step one is you take the estimate of the payments that they're going to get each year from retirement, and you take the percent that we're given times years of service, which is 12 years, times the estimated final salary, and then you're going to take those annuity payments, which means they get paid every year, and present value them back at n equals 20 because there's 20 years of retirement, and we're given the 6% interest rate, and using the present value of an ordinary annuity table, you multiply that by the factor and you get $935,945, and then you have to take that amount and then present value back to 2027 using the present value of a dollar table, and now your n equals 28 because you're present value from 2055 back to the end of 2027, and multiply that by the factor, and your ending projected benefit obligation is $183,099. Let's do a roll forward of the projected benefit obligation, and let's assume that our beginning balance, or end of 2026, beginning of 2027, our PBO was $158,341. Well, first thing we're gonna part of the PBO is the service cost. So the service cost, because we're rolling it forward from the beginning of 2027 to the end, okay? So let's see the items that make up the projected benefit obligation. The service cost is going to be this percent that is provided by the company for the annual retirements. We're only calculating the service cost for the 1 year. We're only calculating for 2027, multiplied by the estimated final salary that this person is going to get, and we have to discount those twice based on the prior slide, and our current year service cost is $15,258, right? That would be debit, pension expense, credit, projected benefit obligation. We also have another item in the projected benefit obligation is the interest cost. So we're going to take our beginning balance of our projected benefit obligation, multiplied by the interest rate we're given, and that's $9,500. Again, that's going to be a debit to pension expense and credit to projected benefit obligation. And then we have our ending projected benefit obligation of $183,099, which is what we calculated in the previous slide. Let's move forward. Now, let's just say we change one of our estimates, and instead of having a final salary of $400,000, we're now going to have a final salary of $420,000. So all things being the same, but for this $420,000, our retirement payments every year increase to $85,680, which we have to present value, go through these 3 steps and present value them to get to our ending PBO of $192,254. So let's see what happens. When we have our projected benefit obligation without the revised estimate, which means we're using the $400,000 ending salary, our PBO is $183,000. When we change the ending estimate of their salary to be $420,000, our ending PBO is $192,000. So now, look, we went from $183,000, right, to $192,000. It has increased by $9,155. So now if we look at our roll forward, right, with this revised estimate, we have our beginning balance of $158,000. Service cost and interest cost is the same as what we calculated before, except now we need to increase our projected benefit obligation by this amount, this $9,155, to get to our ending projected benefit obligation for $192,254. Okay, now this whole video is called Projected Benefit Obligation Gains and Losses, and this is what we're talking about. In this situation, it is a loss on the PBO, and I'll go into why this is a loss, but really if you think about it, it makes sense because now their liability has increased, and whenever you have to increase a liability, it's more of a loss, right? Usually it's an expense, right? That's why you've incurred an expense and you owe more, so you're going to increase your liability. Now we're not going to debit expense on the income statement for this, but it's still a loss, and we'll go through it in a few slides. So what happens is, rather than take that increase to the PBO as an expense, as a pension expense, right? And it can make your whole your net earnings really fluctuate from period to period if the estimates change. Then again, similar to the prior service cost, the companies will report the liability gains and liability losses in other comprehensive income. Okay, and they combine. We'll go into different video where we're going to go for the plan assets gain and losses, right, and how those occur. But essentially for plan assets and gains and losses, we'll also go into other comprehensive income, and those two other comprehensive income accounts, the ones where we have changes to the estimates for the PBO and changes to the plan assets, then specific changes to the plan assets, not all changes, then those other comprehensive income accounts are combined in one account. And then just like net income closes out into retained earnings at the end of every year, OCI closes out into an account called accumulated other comprehensive income, right? And that is on your balance sheet in the stockholders' equity section. But let's go back to this $9,155, okay? This loss on PBO. Let's see how that's recorded. Again, it's not going to be recorded to pension expense so that you don't have all these huge swings in your pension expense unexpectedly. Instead, we are going to debit other comprehensive income / loss. In this situation, it's a loss because it's a debit, and we have to increase our projected benefit obligation by the same amount, $9,155. That's why when there's an increase to the PBO as a result of a change in some sort of estimate, that it's considered to be a loss. And similarly, when there's a decrease, right, if the PBO is going to be lower than previously expected, we would have a gain because we would be debiting the PBO and crediting other comprehensive income. So in this situation, in this example, we talked about a change in estimate to the ending final salary. Whenever you have a change in estimates, so possible estimate changes that affect the PBO, this is when you have this gain or loss that gets recorded to other comprehensive income. But here are some items that would change the estimates. If there's a change in life expectancy, right? If we expect that our employees will live longer or shorter, that goes part into the present value calculation when we use our N equals, right? Or if our expectation that retirement will occur earlier than previously thought. So now, right, so now our service period is less overall because they're going to retire earlier. Or if there's a change in the assumed discount rate. In our example, we use 6% if that rate changes. So all those changes would cause a gain or loss to occur on the projected benefit obligation.